Welcome to Module 5, Section 9, where I will talk about the S&P 500 being the best stock. We all want stock tips. Everybody wants to know about some great stock. In some areas of our life, you wouldn't even consider letting me tell you what to do. What you should do in your marriage, how you should raise your kids, where you should go on vacation, what car you should buy. You would think that I'm completely out of line by telling you what to do, and you would be right. But for some reason, when it comes to the stock market, we think there's some mysterious secret behind all of this, and we want to be able to find out what that secret is and take advantage of it. Well, as I teach these classes and as I've spent most of my life learning about the stock market, there is no secret. The secrets are right in front of us. We just need to know what to do, when to do it, and how to do it. But in this video, I'm going to give you a very good stock tip. Now, it's going to be a little bit surprising to some of you, and it's going to be, oh, great, that? Well, just hang with me on this. I'm frequently asked if I have any inside tips about stocks. Yeah, I used to say, no, I don't. You just have to, what about this? What about that? Because there are thousands of stocks out there, and how do you know which ones are good and which ones are bad? You may get into a really good investment, but it might be the wrong time. Or you might get into a bad investment, and it's a really good time. At that point, you're gambling. You're just taking chances. And although there are probabilities attached to everything in life, we can lessen the odds against us and increase the odds that we will be successful. For many years, my answer would be, that depends. What do you want to do? Do you want big companies where you've heard the names? Do you want a small company that you think might be big in the future? Do you want an American-based company? Do you want something overseas? Do you even want the stock market? Maybe you need to look at the bond market, or a lot of people now are into cryptocurrencies. I would never give people a real direct answer because I didn't know enough about them. Well, I've been able to find something that I think can be an answer for almost everybody. So over 15 years ago, I was able to change my answer to yes, I do have a stock tip I can give you. Very few individual investors know much, if anything, about this particular stock. It's not flashy and it's not cool. You're not going to be able to go around to your friends and brag about this. The idea is that this one will perform over time, and it may not be the latest and greatest trendy investment that people are involved in, but this is something that has worked well in the past and should continue to work well in the future. But this investment is often overlooked and even ignored. But if handled correctly, this is the absolute best stock in existence today. So what is this end-all stock? I'll give you one hint. It's not Bitcoin. I'm not on that bandwagon. I really like the technology, but as of the time I record this, you've got people who have no idea what they're doing, involved in a market that they don't even understand, and they don't even understand the financial markets. They just want to buy something for a low price and sell it for a high price. They don't even care about Bitcoin. I've spent the time studying behind the whole craze into the technology itself, and I like it. I just don't know for me personally if now is a good time to be involved in that. The answer just might surprise you. So, the best stock in the universe? The S&P 500. Wait a minute. That's not a stock. That's an index. And you would be right. There are vehicles that are attached to the S&P 500 that allow us to participate in the stock market and in other markets, such as the options market. And overall, it's the very best stock that I have ever found. SPX is the S&P 500. Hence the name of my program is the SPX Investing Program. The name of my website is SPX. I get all of that from the S&P 500. Many new investors didn't even know that such a stock existed. Many seasoned investors don't take advantage of what this awesome stock has to offer. Now, I'm not saying your life is going to be wonderful and every decision that you make is going to be right on. There will be times when you make wrong decisions. There will be times when you make right decisions and still lose. But when we're looking at the complete package for what we're trying to do and the flexibility that this offers us, the S&P 500 has everything that we need. So taking advantage of the opportunities may require many of you to think in a new way. You're out there digging through all these thousands of stocks trying to find the next great stock. We don't have to do that in the program that I teach. The stock's right there for us. We just need to figure out, what are we going to do? Do we think it's going to go up? Do we think it's going to go down? Do we think it's going to go sideways? And then we implement different strategies that can take advantage of that. So isn't the SPX a stock index? Yes, it most certainly is. And it's been around a long time. It hasn't been around as long as the Dow Jones Industrial Average. It has stood the test of time, and it's a really good benchmark for determining the overall health of the stock market. But it is also a stock that can be bought or sold just like regular stocks. To understand S&P 500 stock, it is necessary to understand a little bit about the S&P 500 Index. So what is the S&P 500 Index? The S&P 500, often just called the S&P, and I refer to it as the SPX since that's one of its symbols, is a stock market index that measures the stock performance of the 505 largest companies listed on stock exchanges in the U.S. You're like, wait a minute, how come they didn't call it the S&P 505? Well, people like to deal with round numbers, and so years ago, Standard & Poor's, who's the creator of this index, they just decided, hey, we come up with a certain amount of stocks and they're right around 500. A few years ago, there were less than 500 stocks in the index. Now, there are over 500 stocks. But just know that there are around 500 stocks in this index. It is one of the most commonly followed equity indices that are available. Most people like to talk about the Dow, sometimes they'll talk about the NASDAQ. But if you want to get a good gauge of what the stock market is doing, the S&P 500 is probably the best. Because it doesn't just have New York Stock Exchange stocks. It also has NASDAQ stocks and American Stock Exchange stocks all within the same index. So it's not as segregated as other indexes can be. And the S&P 500 covers about 80% of the U.S. stock market. So about 80% of the value of U.S. stocks is based in the S&P 500 index. That's pretty good. If you want to buy America, buy the S&P 500. You're buying about 80% of companies' worth at that point. The S&P 500 is weighted, which means that not all stocks are equal. A Microsoft will have more of an influence on the index than some company that you've never heard of. So more valuable companies account for relatively more of the index. And a lot of these big companies, Google, Apple, I mentioned Microsoft, Starbucks, Cisco, Intel, a lot of these companies that you've probably heard of, if you invest in the S&P 500, you're investing in those companies. When compared to other indexes, the Dow, the NASDAQ, etc., the S&P 500 gives the most accurate representation of the current value of U.S. companies as a whole. Now, one complaint that I heard, a number of years ago, I went to a financial seminar, and the person was up there speaking, and they said, well, you really shouldn't follow any of these indexes because you know what they do is they manipulate them. And they take the bad stocks out and they replace them with the good stocks, so that keeps the value of the index strong. And I was thinking, yeah, that's exactly what I want. How would you like to be able to invest in something where the bad is removed and replaced with good, and that there's a level of criteria that's set up for this index that if companies fall below that criteria, they're booted out? I like that. So what one person was thinking is a slam and doesn't really represent what's going on, I'm listening to this going, I really like that. This is really a good investment. I'm going to focus on the S&P 500 and not worry about the universe of all the other stocks out there. So there are criteria that Standard & Poor's has to be included in the S&P 500. To qualify, a company must have a market capitalization of at least $8.2 billion. Now, they came up with this figure, and it changes over a period of time, especially as the stock market goes up. But you know that the stocks in the index that you're investing in have at least a market cap value of $8.2 billion. And that's good. There's some value built in right there. Also, it has to have headquarters in the U.S. Now, they may do business overseas and in other countries. They may even set up factories elsewhere, but the company has to be based in the U.S. And if you're very patriotic, if you have the idea of buy American, the S&P 500 has that criteria met, at least in part. The value of its market capitalization must trade annually, and this is good for liquidity. The next points that I'm going to talk about deal with a thing called liquidity. What we need to know about liquidity is the ability to get in when we want to get in and get out when we want to get out, whether we're using very simple strategies or more complicated strategies. If you have an asset and you can't sell it, that asset is virtually worthless to you. You might have to wait around days, weeks, months, or even years to be able to sell something. The same is true when you're looking to get in. If you're ready to pull that trigger and you've made your decision, you want it to happen right away. You don't want it to be delayed. So knowing that the companies that make up the S&P 500, they have to trade a lot. There has to be liquidity behind these stocks. At least 250,000 of its shares must have traded in the previous 6 months. This also helps liquidity. There are lots of shares out there that just sit day after day after day. Nobody buys or sells them. They just kind of sit there. We need there to be volume based on these shares, and that helps us. The stock market is unique in that the more people that participate, the better benefit that is for everybody, because you can get in and get out quickly. Most of the shares must be in public hands. When a company is first created, it may be privately held. It might be the owners of that company or the family who owns that company. But when they go public, now their shares are available to everybody. What a lot of companies do is they'll go in and they'll buy their own stock. Well, is that really in public hands? Well, S&P has some criteria to address that. But it has to be freely available to anybody who wants to buy it and has the money to buy it. Also, it has to have been at least 1 year, this used to be 6 months, since its initial public offering. That's when it changed from being a private company into a public company. This is one of the big frustrations that Google had, was everybody wanted to invest in Google, and everybody wanted it to be included in the S&P 500, and after it went public, it had to wait 6 months at that time before it could even be included in any of the indexes. So Standard & Poor's says, we know they're fly-by-night companies. We want them to establish themselves a little bit first. We want them to build up a track record, and then we'll include them in the index. So that's pretty good, rather than just some fly-by-night company that's included in the index and they go out of business next week, and now you have an index that you don't know if you can trust it or not. So this builds quality into the index itself. And the sum, which means altogether, of the previous 4 quarters of earnings that are positive, as well as the most recent quarter. Stock prices are ultimately driven by how much money a company can make, and then how much profits can be made from the revenues that are generated, from the earnings that that company has. If they're not having any earnings, then there's really no justification for that stock price to go any higher. Well, S&P has criteria based around earnings, and specifically the most recent quarter must be positive. If companies don't meet this set of criteria, they are removed from the S&P 500 index, and we like that. So that means there's quality built in, and that can really work to your advantage. A lot of the fundamental analysis that you may do trying to find a good stock, it's already been done for you in the S&P 500. So now you can focus on other things. And then other companies that do meet this criteria are added to the S&P 500 index. So this is built-in quality all the way around. I like that. You may not share that opinion, and that's okay. It's just after the research and experience that I've had in the stock market, a lot of the things that I really wanted from a company, the S&P already had those things. So where is the stock? I keep talking about the S&P 500 index, and then I keep talking about a stock tip. What are you talking about here? Well, I will tell you. In the 1970s, there was a man named John Bogle, and he came up with the idea of creating mutual funds that own the same stocks as the S&P 500, and that became the very first index fund. This became very popular and is now known as index fund investing. It's through Vanguard. That fund still exists today, and it's one of the most popular mutual funds in existence. When John Bogle first came up with this idea, people laughed at him. They thought it was silly. They called it Bogle's folly. Well, he proved them wrong, and index investing has become very popular because the S&P generally has a return of between 9 and 10% annually. Most money managers are not able to beat that, at least in the long term. They might beat it for a short period of time or even a number of years, but eventually something goes wrong and they end up underperforming the market, and so the rationale is, why not just invest in the market and not worry about these high-fly money managers who are supposed to be geniuses, but they can't even beat the market itself? So then what happened? In 1993, another idea was to create shares of a stock that made up the S&P 500. What John Bogle created was a mutual fund, and you can only trade that after the market closes. And then it calculates a thing called an NAV. And so there's a real time lag. So somebody came up with the idea, well, let's create a stock that is really the S&P 500. And you can buy and sell this just like you would stock. So theoretically, you could buy it at 10 o'clock and sell it at 11 o'clock, where you can't do that with a mutual fund. This has become even more popular and is known as an exchange-traded fund or an ETF. And I have other videos out there that talk about ETFs and that talk about mutual funds. And there are strengths and weaknesses to each. ETFs can be traded while the stock market is open, where mutual funds are usually only traded, you enter or exit, when the market is closed. Now, you have to put your order in before the market closes in a mutual fund, but the actual process of it taking place will be done after the market is closed. The ETF that we're looking at for the S&P 500 is called the SPY. That's the symbol. They're known as the spiders. So the SPY has become the most heavily traded stock in existence. Now, as we go through this post-COVID-19 pandemic and recovery, there are other stocks that have become very popular and that do have a lot of volume, but day in, day out, year in, year out, the SPY is typically number one when it comes to average daily volume. And it's way number one when you look at the assets under management. And to me, that's built-in quality right there. That means a lot of very smart people are not only active in this stock, but they're willing to put their money into this stock. Since the average volume is so high, this allows for excellent liquidity, the ability to get in and get out, and execute a lot of more advanced strategies that can really produce some nice returns if you know how to do them. Liquidity allows for numerous strategies to be used. Now, there are other ETFs available. There are ETFs on the Dow. There are ETFs on the NASDAQ 100. But after studying these and using these for a number of years, none of them have the liquidity and then the flow through liquidity into some of the other products, such as options. Whether they be call options or put options, they're not quite as liquid with the other indexes as they are with the S&P 500. And that's why I settled on this particular index. What are some of the strategies that you can implement with the S&P 500? You can be very conservative to very risky, and anywhere in between. So if you really are concerned and you don't like to take a lot of risk, the S&P 500 can meet your needs. If you like to live on the edge and you're real radical and you're a risk taker, the S&P can meet your needs. And then anywhere in between. What you have to think about is risk versus reward. If you want a high reward, typically you're going to have to take more risk. And the inverse of that is also true. One thing that I will tell you though is, any investment where you lose money is risky, and any investment where you make money is conservative. So you might get into something and just time it right out of pure luck, and it really has the characteristics of being a risky investment, but you end up doing really well in that. Other times you may look at an investment that's considered pretty conservative or a strategy that doesn't take a lot of risk, but your timing was wrong or something just went wrong in that whole process and you ended up losing money. Conservative and risky are relative at times. A lot of times it's going to come down to what do you feel comfortable doing. You determine what risk is, and you determine what levels of risk you're willing to take. So this can be tailored to multiple time frames as well. There are different definitions of time frames, and the way I define them is short term is days to weeks. Some people consider it minutes to hours, but for the program that I teach, it's days to weeks. And then intermediate term is weeks to months, and long term is months to years, to decades, to even generations. You can have multiple time frames all going at the same time. And they can even seem to contradict each other. You might be long, which means you're hoping they'll go up in some of your longer term investments, but you see some trouble on the horizon, and you implement some short term strategies that benefit when things go down. You keep your long-term strategies where they are, but then you make some profits in the short term, and it helps to balance things out. So overall, you're doing much better. They can also be used to take advantage of current market conditions. Most people understand that you can make money when the market goes up, but most people don't realize that you can make money when the market goes down. But then, about 60 to 80% of the time, at least from about 2013 through 2016, the markets went sideways an awful lot. We're seeing a lot of intervention by the Federal Reserve, and that's really keeping prices propped up high. And sometimes prices may stay high, but there's really no trend going on. What do you do during sideways movements? Well, there are strategies that you can take advantage of that make really nice returns even when the market doesn't really go anywhere. So the S&P 500 is a good vehicle to take advantage of all different kinds of market conditions. You can also have varied goals. Maybe you want capital gains. You want to be able to buy at a low price and sell at a high price. Or protection. A lot of people have spent 40, 50 years of their life investing, and they're getting either at or near retirement, and they don't want to make the 20, 30% gains anymore. They just want to hang on to what they already have. And so you want to implement levels of protection so that if things do go south, you're not going to lose everything, and if you retire, you'll be able to stay retired. The S&P 500 does allow you to implement protection, or think of this as insurance. And you can even apply this across a whole portfolio. But there are mechanisms built into the S&P 500 that will help you protect other investments in the S&P 500, as well as produce income. There's the ability to produce weekly, monthly, quarterly, annual income from the S&P 500. Now, there are other investments that let you do that, but they're not as liquid as the vehicles that we use within the S&P 500. You can also have strategies that are very simple. You're just getting into the SPY, you think it's a good time to buy, you hang on to it for a period of time, and then you get out. That's pretty simple. Or you may go long and short. Or you may end up implementing some sideways strategies. Or you may get even more complicated than that. You can tailor it to who you are, the time that you have, the goals that you have, and the abilities that you have based on what you've learned about the markets. So it really is a one-size-fits-all stock. It has something for everyone. Each individual investor can develop a strategy that works best for them. You can tailor this to yourself. That's what I do in my program. I don't have a program that I just say, follow this and you're guaranteed success. No, I say, what are your goals? What things do you want to do? What are your risk levels? What's your knowledge level? We take all of that together and then develop a program that's specific to you. Do you have a lot of money or not very much money at all? Maybe you don't have any money. You can still benefit from this program. Also, it allows for flexibility. Let's say that you like the more complicated strategies, but now you want to go on vacation for a week or two, and you don't want to be tied to the market. You're going to be out in the middle of the woods somewhere where there's no internet access. And so you may dial down some of the more complicated strategies and just stick with more of the conservative ones while you're gone because you can't really watch things all that close. And then when you come back, you can implement some more of the complicated strategies. Or there are different seasons of life. You don't invest the same when you're in your 50s or 60s that you do when you're in your 20s or 30s. You don't invest the same when you're single that you do when you're married. Things change in our lives and we have to adjust things to where we are at in our life cycle. The S&P 500 allows you to be flexible to those different changes and to those different stages and periods of your life. You can implement multiple strategies at the same time. I talked about that just a minute ago. You could be anticipating the market going down in the short term, but in the long term, you think it's going to go up, and you can take advantage of both. No stock selection is needed because the S&P 500 index is maintained with quality stocks on our behalf. Standard & Poor's set up that criteria. The S&P 500 is a very popular index. For a company to be included in that index, they have to meet a certain level of criteria. So we have quality built in. We don't have to go out and find all these other stocks. Now, you can still do that. And some people really get a kick out of trying to find the next latest and greatest Microsoft or Google. But it can take a lot of time. And it can lead to a lot of dead ends, either in your search or in your investment. New instruments that are directly tied to the S&P 500 are being developed continuously and used. When I first started teaching this program, mutual funds were the only thing available. Yes, the SPY did exist, but it hadn't been around all that long. And I just wanted to watch it for a little while. And then I wanted to watch some of the other derivatives or option contracts that trade with the SPY and just see what is their volume like. What are some of the strategies that I can implement that I can't do now? And so I just watched it for a period of time and then ended up changing over to focusing on the SPY. There are instruments that we have available to us now, like weekly options that 10, 15 years ago didn't exist. And these options are becoming more and more popular. There are other instruments that they've tried, such as single stock futures, that have never really become all that popular. So some things may really grab hold of people and they may like it, while others may not be all that advantageous and investors may just pass. So knowing what to do and when to do it. Each day, each week and month, in addition to watching, listening, and reading about what is happening, I look at over 300 points of data. Now, what does that mean? I look at over 300 points of data as it applies to the S&P 500. That's one of the beautiful things about this. The S&P Index gives off so much information. Instead of just looking at the outside of the car, we can open up the hood and look inside the engine. There are studies and there is different types of analysis that we can do on the S&P 500 that you can't do on an individual stock. And that just gives us more ammunition to make good decisions. What I use are a lot of charts. I use technical analysis, or TA. And there's other things that I look at too, but the main focal point are charts. The charts tell me, either directly or indirectly, if the S&P 500 is likely to do something either the next day, week, month, or even year. Now, I try not to forecast out too far, because that can be really silly, and the people that do forecast are often proved to be idiots, and they're very incorrect in their analysis. Usually I just take it one day at a time and then make the decisions for all the different parts of the portfolio, and I teach people how to do that in my program. This is a skill that I've spent over 25 years developing, and I continue to develop it each day. I'm reading, I'm studying, I'm listening to people, I'm trying out all new ideas all the time. Some of these ideas get thrown away, others are implemented and can be a real source of good information. Then teaching others to develop this skill for themselves has become my calling in life and my true passion. I have a real interest in the stock market, and I really enjoy that. But number one, I'm a teacher, I'm an instructor, I'm an educator, and few things give me as much personal gratification as taking the knowledge that I have, passing it on to someone else, and then seeing them develop a skill that they can use for themselves. I'm not telling people what to do. I am a guide. I try to guide people into what they want to do, what is best for them, and it's going to be different from person to person. This concludes Module 5, Section 9, and I will pick up with things again in Section 10.